time frame charts to trade with the market makers? Like, what is it you're specifically looking at the higher time frame charts to derive a specific insight from? What is it that you're supposed to be doing? We're going into details about that, and we're going to be revisiting the range expansion and range contraction concepts that I'm familiar with in many of my older teaching tutorials. And we're going to be looking at price equilibrium and price disparity theory. We're going to be looking at institutional pricing as support and resistance. We're going to be, in a certain sense, revisiting the Power 3, which is my ICT accumulation to distribution concept. And when are stop rates likely and how to anticipate them. How to visually see institutional accumulation and distribution in price. And what does institutional order flow look like in price action? And how market makers reinstitute and reclaim previous order blocks. And we're going to discuss why pattern trading is not pattern hunting. And we're going to be looking at time and price in conjunction with news and market data releases. So let's take a look at the first in this list of specific concepts and ideas and theories. Glean what it is specifically you should be looking for in your higher time frame charts. Okay, folks, we're looking at the British pound, USD, otherwise known as the cable in the FX market. Now, when we look at the higher time frame charts, we obviously start at a monthly, work our way down to a weekly, then to a daily, then to a 4 hour. And then below 4 hour, we only concern ourselves with the 60-minute, 15-minute, and 5-minute. Now, prior to going below a 4 hour chart, it's imperative that you understand where you're at in the higher time frame, because contrary to what you might believe, okay, and what's being led, you know, to have neophytes believe on the internet, and many courses and authors focus on having a 1 minute perspective or a 5 minute perspective because uh, they're so ingrained with the thought process that the intraday charts are closer to the market. No, I'm going to dispel that whole idea right here. Is there a benefit or a use of using those lower time frame charts when you have a perspective that's based on a higher time frame? Certainly, yes. But by far and large, you're going to learn, and you probably can admit if you were in a classroom setting with me, you would all probably be raising your hands now. You were all indoctrinated into the technical analysis world with foreign exchange with lower time frame charts like 1 and 5 minute charts or even tick charts. Well, that's really not getting you closer to the market. Okay, I'm actually going to turn the tables and actually show you how you really get closer to the market. Okay, because the market is defined by the deep pocket institutional bank traders. Okay, they are the market. We are just fleas on the back of that dog. Now, sometimes they'll scratch and kill us, and then other times we're lucky enough to ride along on their coattails and you get to wherever they're trying to get the market to go to. But it's important you understand that in this whole series, I'm trying to pull back the veil, if you will, for all of the retail traders to get a institutional perspective that is not really taught, um, as it relates to using price action. By far and large, you're going to find, if you look at all the things that are available, everything is based on a retail perspective. Indicators, mathematically derived on what's happened in the past on the left side of your chart, type thing. And just because you're looking left doesn't always give you clues to the future. Okay, not just simply looking at retail indicators. Okay, that's not going to do anything for you. And just looking at old highs and old lows isn't enough either. You got to look inside what price action is depicting, okay, to suggest what it may do on the right side, the hard right side of your chart. Okay, so it's very easy for new traders to to latch on to someone as a mentor or a teacher or read a book or such and see examples of things that worked in the past. And we all understand if you've opened up a demo account, if you opened up a live account, if you read any, structured teaching about trading, the first thing, if they're responsible as a teacher or an author, they're going to tell you past performance is not indicative of future results. And that's true. And that is not any exception to my rule of trading either. My things aren't always 100%. In fact, what you're going to find is many times when it fails, it's because we, the trader, misinterpreted it. Okay, so there's always a human fallible component to everything, and trading with my tools are no exception. Okay, so keep that in mind. But over time, okay, and remember, I've been doing this for over 20 years now. It takes a lot of time to get to the level of appreciation and trust in these things. So if you're just now starting to warm up to my material, okay, this again, give yourself some time and permission to develop into the trader that you'll be able to utilize this stuff in time, consistently, have faith in it and trust in it. But now, what is it specifically that we're going to be doing with all the things if you've always learned in all my teachings and my review videos? How am I arriving at all these things? What tools do we mesh together on a higher time frame, and for what purpose? What is it? What is it supposed to give us? Um, are we to derive a bias, or how do we trade without that bias on a higher time frame? And we're going to get into that now. Now, looking at the monthly chart, now obviously this is going to have the benefit of hindsight in some respects, okay, but you're going to be able to see this is how it's done going forward, and you'll see everything with a different perspective after having this installment in this particular video series. When you look at the higher time frames, starting with the monthly chart, you're going to be looking at areas of old highs and lows where they had significant reactions. Okay, and by that I mean, like, obviously you see a low here, it reacted very strongly there. We have a low here, price reacted very strongly there. We have a low here, price reacted strongly, and another low here, rather significant reaction in price. We had a high here. Okay, price came down. We had a high in here. We had a high in here, price reacted very handsomely. We had a low, a high. We had a low in here. We had a high in here, rather significant high in here, and we're right now below these lows in here. And if you've been following my commentary on Twitter and or my review videos and live webinars, I've been telling everyone for months that we were going to go below these equal lows and trade into this low, and maybe even go a little bit lower. And that has since come to pass. We have a low back here as well, and this high, a low in here, and we have a low in here and a low here. Now, obviously, you're probably saying, okay, well, this is pretty obvious, Michael, and you're starting to bore me. Okay, well, that's good. You want to be bored. Okay, trading should be boring for you. It should be a monotonous, redundant process that goes on and on and on, but yet profitable. Okay, so now what we look for is areas of range contraction and areas where soon after there was range expansion. Okay, now what do I mean by that? Well, we had an area in here where we moved from big ranges, the large range moves lower. Okay, now again, mind you, this is a monthly chart, so these ranges are depicting the high and low, open and close of that particular month. So there's a lot of price action inside of these candles. The market moved in large ranges down, and then started to have contractions. They were going into smaller ranges, smaller ranges, smaller ranges. And then what happens after small ranges? Large ranges. Okay, this is one of the concepts and cycles that I learned from my mentor, Larry Williams, and it's a rather generic cycle in the marketplace, but it really goes unnoticed. And if you look at what you did when you first started trading and you put yourself in front of a demo account, whenever the market started ripping higher and started taking off, moving aggressively higher, what did you feel compelled to do? In all honesty, if you're going to be honest, you're going to say you felt this insatiable desire to want to click the buy button. Okay, you wanted to chase price. Well, that's what retail traders do. They chase price. After it starts moving, they want to chase it. A institutional or smart money minded trader, which is what you're aspiring to be and what I'm trying to teach you to become, you're going to evolve from that perspective, okay, into the opposite. You want to be looking to be a seller of a position you hopefully have already obtained along on when markets are running up. Okay, and you want to be looking to be a buyer when markets go lower. Okay, it takes a little bit of a paradigm shift where you're buying in the depressed market where it's dropping. It doesn't feel good to be buying. It feels like it's going to continue lower. That's where retail traders lack the perspective that's needed to overcome, number one, quickly the dealer spread. We all have to overcome that. I'm not outside the scope of that. I mean, all my trades enter the market with a deficit. I have a spread that I got to overcome just as well as you do. If you trade when the market is moving lower and you're buying in that instance, okay, you will quickly overcome that dealer spread in just about no time, really, many times, instantly, many times if you do it right. But contrast that with when you were trying to chase price. Okay, if you're buying in that, you may sit through some intraday or intra-month, in this case, retracements that may have even stopped you out, or worst case scenario, didn't really come to your stop, but it scared you and you collapsed the trade before it actually seen the trade come to fruition. Why would you have done that? Because you chased price and it didn't see the rather you didn't see the continuation of the move higher that you were anticipating, because you've already seen it move 20, 30, 40, 50, 80, and even 100 pips, and then figured, well, it's been going up, so it's going to continue going up, and then you obviously will have a retracement of some sort. Well, what we like to do is we want to see price move from an area of contraction, okay, with a spirit of anticipation of range expansion. Okay, we also want to be looking at areas where we had clear discernible order blocks. Okay, now the larger magnitude of the move from a particular low, okay, or high, is going to be important. Okay, it's going to be significant to you in terms of what type of trade you're going to view this as. Just because you're on a higher time frame chart doesn't necessarily mean it's going to be a long-term trade. Okay, it could be a one shot one kill setup where you're just doing a short-term trade, or a weekly setup where you're trading, for a couple days, from maybe a Tuesday to a Friday hold, or maybe a swing trade where you're holding it for a couple weeks. It's going to hinge upon your understanding of market structure as it relates to long-term low, intermediate term low, short-term low, and where we're at in the scope of that overall market structure, and where are we at in terms of a buy or sell model, and are we in a buy or sell program. Now, if you're familiar with my previous teachings, I'm not going to reiterate all those things here. Okay, a buy and sell model is not the same thing as a buy and sell program. Okay, buy and sell program. I'll just tell you this. Go back to my previous courses and teachings, where we use the moving averages, 18 and 40, and 9 and 18. When they're stacking up, you're in a buy program, and when they're stacking lower, you're in a sell program. Okay, the buy model is contingent upon you understanding the market maker buy or sell model. Okay, so you're going to blend those two to get a bias, and we're not teaching bias here. We'll go over that in greater detail as it relates to specific trading styles in the later modules in this series, but for now we're just going to look at what you're specifically looking for on the higher time frames to begin to flesh out trading ideas. Okay, it does not depend upon a trading bias. Okay, and I'm going to show you that here with the higher time frame. We have a large reaction in here. Okay, and what we're going to do is we're going to put a horizontal line on the top of this bearish candle, because it's the down candle prior to the move up. We have that nice reaction in here. Okay, and then price comes back down. So we had range expansion, goes down, retraces, and goes into contraction. You see that with smaller ranges. What do we anticipate after that? Range expansion. Price sees a move higher, the ranges start getting larger. Okay, the public starts to chase it. What is it going to do? Invariably, it's going to retrace and move back to a previous area of buying. Here's the down candle prior to this move up. Price comes right back down into that area of this down candle or bullish order block. Okay, we get into smaller ranges again. What's going to happen after the smaller ranges? Range expansion. Okay, another move higher. As we see this cycle of range contraction and range expansion, Okay, you're going to see that and dovetail that with your order blocks. Okay, when you see a bullish scenario and the market starts to retrace back into it, you want to anticipate the range to start to get smaller and tighter. Why is it doing that? Because they're slowly buying into the position again. Okay, they don't want to add real big positions all at one time because it'll cause the market to take off, and then it'll cause thin gaps, and that's not conducive for smart money to build large positions. So they have to do the buying as it drops, yes, but when it gets around that particular level that they want to average in at, they will do smaller little portions. They'll break their buying up into smaller blocks, so that way the market can digest it a little bit better and still stay close to what would be deemed at the time a fair market value. That way there's no disparities created, and it stays within an area of price equilibrium. Okay, so overall, if you look at the overall range in here, we have the high of this candle here and the low of this candle, and I'll give you an idea what I'm referring to here. If we look at that in the sense that this is a trading range here, okay, um, between the high and the low, if you look at the 50% level of those two price points, and let's just bring it over here so it's a little bit easier to see right in here. 50% is right in here, so this is what would be deemed fair value or equilibrium between the high and the low. So the low here and the high. So equilibrium is right in here. And if you look at the overall price in here, there's a lot of times where price had traded at that level, but when it moves away from it, it's kind of like if you had a rubber band, if you will, and it was anchored to this particular price point, and if you stretched it lower, okay, it's only going to go so far, and then finally it's going to snap and go the other way and go to an extreme on the upper end of the 50% or fair value. Okay, and then what will happen is it'll come back down again and stretch below that equilibrium or halfway point of the total overall trading range. Okay, and what it's doing is every time it stretches away from what would be deemed equilibrium or fair value, it's creating a price disparity. In other words, it's not, this is not going to be deemed um, uh, a fair value. It's going to be viewed as a discount. Okay, and this right here would be creating a premium in that price. Not premium in the sense that we talk about commodities, so don't get that confused. In other words, you're going to be buying inflated pricing here. You don't want to do that. You want to buy very cheap discount prices. So if you understand equilibrium, okay, and equilibrium is finding overall trading ranges in consolidation, okay, and when we see consolidations and we identify trading ranges, we like to see where are we at in terms of the overall trading range. Are we below the 50% level? Because if we are, we're below what we deemed fair value or equilibrium. And it's going to create a disparity in price. It's going to be viewed as undervalued or discount. So what will happen is buyers will come into the marketplace on an institutional level, and depending upon where you're at in overall market structure, it will give you the basis for a longer term trend, higher or lower, based on that understanding. And again, I'm speaking conceptually now, and we're going to build on it as we go through this video and the latter three in this series. But for now, again, I want you to understand that this is a bearish candle prior to this move higher. That's a bullish order block, as we identified in previous teachings, and we've reiterated in this particular series as well. But this level, okay, this is just one. Then we have an area of consolidation in here as well. Okay, price moved from big ranges down into smaller ranges again. Okay, and then price moved away from it and started moving into larger ranges. What we're going to look for again is the bearish candles prior to the moves that take place moving higher. We have a down candle here, so we're going to create another notation with a horizontal line on that. And this little candle in here, and it's a small candle, which is good because what did we talk about just a moment ago? Small ranges beget large ranges. Okay, while the market's real quiet and you seesawing back and forth in small little ranges, no one's really interested. Retail traders aren't excited. They'll say, well, we're in the doldrums. Oh, it's choppy, or it's not going anywhere. And what are they going to do? They're going to look for another pair or another market asset class to be putting their money in because it's exciting somewhere else. Smart money is going to be interested in the markets that are quiet. Okay, it's just like when you're trading options, and we're going to talk about that later on in this overall uh, teaching, because I'm going to be talking about options trading in stocks and commodities. But you want to understand implied volatility. When implied volatility drops below historical volatility, that means the market has become quiet. And when those periods of quietness come upon, price action really just heats up and you get this injection of volatility, and boom, you get these big moves. Well, the same thing happens when you just look at the ranges on the market that you're trading. If the ranges are big, don't chase it. Just wait for it to go into a retracement or move into a level of higher time frame order block, and then look for a pattern later on based on that understanding. But using the ranges between large ranges and small ranges, you want to look when the market's trading small little ranges. That's when you anticipate these next big moves. Okay, we're not interested in chasing price. We're anticipating price. It's a big paradigm shift from what retail perspective traders are doing and what we're doing. Okay, we are not gambling. We are not throwing dice. Okay, we're looking where the highest probabilities are in our favor of seeing a dynamic price move. Okay, so now we have a down candle here. Okay, this down candle is already identified, but we have this one as well. The body of that candle is basically encapsulated with this line as well, so we're going to keep that exactly where it's at. Now I'm going to ask you a question. Do you see anything about this particular level that may be of any importance? Look closely. Look at the lows of these candles back here. Look at the high of this candle. Look at the bodies of this candle here. All these three candles in here. This candle here, the body of this candle, the body of this candle, and the body of this candle, and the body of this candle. You see how that's all really close to that same overall price level? What is that suggesting? This is suggesting that this in here is what would be deemed an institutional price level, okay, for trade. Okay, not an institutional price level like the 80s, 20s, 50s, and evens like we talk about. But what I'm saying is this is a good level to anticipate actual trade entries at, because there's a lot of activity around that particular price level. And you can see that they were in fact interested there because it took off and then never came back for a long period of time, many years actually. Moving on into present time of this recording, you can see the price had just recently come down to these areas, okay, as well. But when we get around these levels, just on the higher time frame, they have to be refined on the lower time frame, and then we're going to do that in this example here. But um, the next idea I want to bring your attention to is when you're looking at higher time frame charts, you also want to look at the overall market structure, not just the order blocks or old highs and old lows. You want to be looking at the overall price structure. Okay, if you look at what we have here, we have the market moving up from a low to a high, and then we have another market swing from here to here, okay, which is comparable to this move here. We have this low to this high. Okay, so we have a dominant price swing here, a retracement, and then another rally up. But this price swing here is the second leg of what this leg is already done inside of this initial parent price swing. So if you look at what we have an equal distant measured move type thing, an ABCD extension is commonly referred to in price action or technical analysis, if you will. This low here is significant. Why is it significant? Because it's one of a multi-leg price structure. So now, knowing that, combine what we've just discussed. We have a market that moved from big ranges down into smaller ranges, and we moved into consolidation. What is going to happen, or what we would rather expect to see at that time? Okay, and again, I got to speak in a certain measure of hindsight here to be able to teach the concept, because what I'm going to show you in a moment, it's going to be a lot more significant to you. But for now, understanding that just because we're looking at old lows isn't enough. You want to look at the market structure as well, because what I'm saying to you here is there was a lot of buying here, there was a lot of buying here, but there was a lot of buying here as well. Okay, so there was a lot of order flow entries right in here in the long side. Why? How do we know that? Well, because it obviously took off. But why would we expect that? Well, if you go through the candle here, cut right on through that, you'll get to these highs over here. Continue going over to the left again. Cut through these candles. What do you see? A lot of buying here as well. See that move here? See, there's this idea that supply and demand is what I teach, and it's not what I teach. Okay, I teach institutional order flow. I teach how the banks view charts, how they look at areas of previous fair value and price disparity, and where they look to do their buying and selling, okay, is important, not how supply and demand traders look at price. Okay, I don't care about rules that were created by a ticket runner not to cut through candles. Okay, I worked and rubbed elbows with bank traders, and I'm telling you, we don't care about cutting through candles, because you're not going to see institutional buying if you just stop at a present range and never look beyond it. Look at what I'm suggesting to you here. You're going to cut through this area here is of importance. Why is it important? Because if you cut through this candle here, go all the way over here, this level here is now significant again. And cut through this candle here, this area is significant again as well. Now, if we take the body of the candle, right here, just the body, we're not looking at the long wick, okay? I just want to focus on the body of the candle here. You nail it here, and you're in it here as well. But more importantly, prior to this big move, look what the body of the candle is on the down candle prior to the big move is. It's inside that area. Supply and demand does not give you that precision. ICT does. Okay. Now, I'm not patting myself on the back. I'm just telling you, you are light years beyond what everyone else is teaching and learning from everyone else, okay, out there on the internet and all these other supposed seminars and teaching, circuits. They're not aware of this stuff, okay? Um, you are going to be limiting yourself if you do not cut through candles. Okay, you got to go through it. You got to go through and look at overall price structure and blend it with institutional order flow. Who were the participants that caused this market to move up? Is it supply and demand traders? No. Is it support resistance traders? No. Is it retail traders? No. Absolutely not. It's not baby pips. Okay, it's not FX Street people. It's not Forex Factory Forum guys. It's none of those people. Okay, it's banks, institutions, large firms. They are the ones that create these large extrapolated price moves. Okay, so when you're looking at price, you have to identify when markets are moving significant. Okay, those are footprints that large buyers or sellers are interested in those levels, because in those levels, okay, we're in areas that they're going to be doing future trading again, okay, and they're going to be influential to you as a price action trader, both on buying and selling. And how we measure that and lay that out with market structure, and we're going to talk about that in this video. It's going to be paramount to you being successful using these concepts. Now, do you need these concepts to be profitable? Absolutely not. But you will not find anything else this precise that gives you the foresight to know when to anticipate it, how to anticipate it, and have the, well, everyone asks me all the time, the bias, if you will. Okay, this is how I arrive at it. Okay, so now, when we see these areas, okay, all they do is draw the attention to where there's large institutional order flow. But they have to, much like everything else I teach, they have to be further refined. So now we have an area in here. We have this down candle right here. Okay, that down candle prior to the move up here, it retraces back into it right there. Okay, and then boom, it takes off. If we take this idea, in much in the same vein that we cut through going to the left to find historical support and resistance theory in the order blocks and market structure, okay, this concept can be projected through candles like we see here. And if you look at what we have, we're going to just take um, the range and just extend it out in time, and you're going to see all of a sudden this reaction that no one else saw. But we talked about this level here. Okay, if you look at my old videos, we talked about the likelihood of the 172, the 171.80 level. Okay, that would be a significant area to expect some selling pressure. Okay, and in fact, when price was rallying up here, we were talking about the false breakout idea above this high here and this high here, moving up into this old low. Now, traditional support resistance traders would expect you to believe that it's going to work like this. Okay, and you're going to see a glaring disparity between what we teach and what actually happens. A low here on this candle comes in at, let's get it on there, the low comes in at 170.46. The actual high that it moved to was 171.92. That's a pretty significant difference. Now, not so much if you're a higher time frame trader and you use multiple hundred level uh, stops. In other words, if your stops several hundred pips, which I don't trade that way, but I mean, there's traders that can trade that way and feel comfortable doing it. This probably wouldn't be a big deal to you, but because I'm an intraday timing type trader, I like to use a 15-minute and 5-minute entry on something I've arrived at on a higher time frame. That's this big disparity between 170.44 and the 171. What is it? What do we have here? Get back to it again. 171.92. I mean, that's a significant difference in terms of overall risk exposure, and in deference to the pips that's necessary for your stop. But what I'm drawing your idea of looking at price in a way that it will give you the understanding that's necessary to flesh out areas of anticipation when we anticipate price. Well, when we're looking at higher time frame price charts, and say prior to this move up into this high here, as price was rallying up, we were bullish all through this. If you go back and look at all of my YouTube videos, we were calling higher prices in the cable, higher prices in the euro, lower prices in the dollar. And if you go on my website, you'll see links for market reviews that were discussing all this as well. The idea was you look at old highs, okay, for price to reach to them. And until we reach them, you maintain a bullish stance. Now think about what I just told you. Okay, write this down in your notebook in big bold letters and then highlight it and circle it and underline it. Okay, when you're looking for an idea to trade on, when you're looking at higher time frame charts, where we are at now, presently, you ask yourself, where is price reaching for? What price level is it reaching for? Where is the next level of institutional interest? Okay, prior to this move higher here, there would have been an interest above these highs here in the form of buy stops. There's a lot of traders that believe that if they break this high here, it's probably going to continue all the way up, maybe even trade back here. Now, obviously, we saw that wasn't the case, but there's a lot of people that believe that in the market. And there would be traditional support resistance traders would say this would be a good area to anticipate price reaching to, and that would in that camp they would be correct. Okay, but when you understand institutional order flow, let me ask you this: does this high and this high have any institutional um, significance other than the fact that there would be buy stops above it and here as well? No, because all we have here is a big range. We have this really big range in here. Okay, so you got to cut through that range and find out what the previous institutional structure right here. Boom. You got to go through candles to find out where price is most likely heading. Now let me ask you a question. The buyers that would have had positions here and were long here, okay, when the market traded through that, did it ever get to that same level again once it broke through? This is the closest it got. And then we had to go through 4 years to get back to that same price level right there. Now, let me ask you a question. What retail entity would hold a position that long losing? I would argue none. Most of you can't even stand an hour, under the water in a position before you start going crazy. But I'm going to remind you about something that, again, the retail universe cannot grasp this concept. But banks can hold net loss positions a lot longer than you would have yourself believe. Because they are the market, okay, they are willing to allow themselves to sit with a deficit on their books because they have other transactional costs that they charge their customers that help offset the what would be deemed as a net loss or losing position on an open position, if you will. They're able to um, kind of like diversify their income to offset, not entirely, but offset some of the um, the adverse problems of holding that loss on their books. They will, when price gets back to these levels here, they will then unwind what would be at the time here. Okay, once it's taken out that low, now they're in a net loss, a rather significant net loss position. Okay, you're looking at a very steep decline. Okay, and this is exactly when we had the banking fallout. We had all that issue with the banks potentially failing, and we had to do the bailout. Everyone knows about that. But now they had an opportunity to now mitigate that. So everything they were sitting in with any positions that were net long still from this point on and holding on to it. Okay, they had to sit through all this, and then technically they came out of it right here, and that's what you're seeing. Okay. Now on the lower end, okay, because we just described how we cut through all candles to get to an area of understanding of where institutional interest is on higher time frames and how we look for price action to move to different levels. When price started to fall from here, the question is going to be is where would there be an interest of seeing price get to? We have a down candle here. So as price was dropping, this was a significant level to be monitoring. Okay, if you look at the bodies of the candle, there was a significant interest there. If you go down to a lower time frame, you can clearly see, and I'll let you do this on your own study. You could have been taking trades on both sides of the market, I'm certain, around that same level. Now, did it continue on lower? Yes, it did. Okay, what will be the next level of interest? The down candle prior to the move up. Okay, it's going to reach into that. Okay, we got down through it around the holidays. Okay, and then below it would be these equal lows because we understand that there would be sell stops below these lows, and there would be a liquidity void down there, and price would reach for it. Okay, price coming down into a level that if you cut through candles now, we're going to cut through this bunch of candles, we're going to cut through this bunch of candles to arrive at the same order block we had back here. It's the beginning of this move here. Now we're back in an area of price sensitivity again. Okay, so we can anticipate an area of buying pressure to come into the marketplace again. So we're looking at higher time frame charts with an idea that where are institutional traders most likely interested in trading based on what's already happened in the past and previous footprints that they've left. Because if they were interested in buying it back here, okay, that's a significant price level if we get back to it again, especially if you understand what it means in the whole grand scheme of things. If this position was a buy and it went through it here, they're going to want to get out of that there when it gets back to it to mitigate that. So this is a bullish order block that becomes a buying opportunity here for a buy setup, but it becomes a mitigation block later on in time. And yes, you're cutting through candles to arrive at that understanding. Okay, so again, it's not supply and demand, guys, it's institutional order flow. Now looking at what we have here, if we take ourselves down one period and we go to a weekly chart, And let me click the weekly chart tab, not the monthly again. Okay, we're going to zoom out again, and let's get this off because I don't need it. We have this trading range defined here, okay? But look, we have this reaction as well. See this reaction? We're going to zoom in on this little area here, right in here, okay? We have big ranges, and then what happens? We go into small ranges. What's the small range going to create? Big ranges, okay? And then we have down candle, range expansion again, retracement, small ranges, big ranges, retracement, big ranges, small ranges. Then what's going to happen? Big ranges, okay? What you're looking for, again, is areas of liquidity, okay? In other words, above old highs and below old lows. And you're looking for previous areas of institutional buying and selling, okay? And from areas of consolidation. So if we can see areas of buying interest, like we see here, okay? What I like to do, and this is one of the concepts you've probably seen in my I'll move that when it needs to be moved correctly in a moment. In my old videos, I would look at an area here and I would highlight it with a square or a block on MT4, and I would use it as a marker, and then we would zoom into that little area and then refine down to really precise order blocks that we could trade on. That is certainly what you can do, and I'm not trying to discourage that, but I'm trying to give you a higher level perspective on what you should be doing with higher time frame price charts. And what we do is when we see price action like this, we have the down candle. Now, yes, there's a big, large wick in here, okay? But we have to identify the top of that candle is the beginning and down to the body of the candle, okay? And let's take this off for a moment. We don't need that. It's going to be confusing. So we have this range to consider for all this buying, okay? As price drops down into this, we are anticipating something that would stall, okay, price moving lower. Doesn't mean it's going to stop going lower longer term. It just means that there would be a likelihood that there would be a bounce in a bear market. Now, last week, if you followed me on Twitter, at the time of me releasing this video, I stated that we were going to be looking for bounces in a bear market. And when we say that, okay, your mind should immediately click to, okay, where are all of the buy stops? Because that's when buy stops are going to be looked to be rated, okay? Because it's a down market, it's been suppressed for a long period of time, and as the market drops, the market participants that have been bearish will be protecting their position as it drops in the form of placing buy stops right above what they would deem a significant resistance level or a short-term high, and they feel that, you know, if it goes up to that price point, they don't want to eat into their open profits any more than that, and they limit their exposure. Well, that's exactly where the price is going to reach for. So when you're looking at price action and you anticipate levels like we're discussing here, okay, yes, the market's in a sell program, it's in a bearish trend. It is in an area of old institutional interest where there was significant buying back here, okay? We're inside of the range here, right in here. The bearish candle, okay? You got to use the high to the body, okay? Now, there's an idea that's tossed about that it's a dynamic way of trading if you look at for instance, the body of the candle down to the wick. If price was to trade down to that price point, it would be a good buy. You know, that's not how you use the wick to body principle. Okay, how banks would view that. Okay, what we see here is this is actually how it's being done. You find the body of the candle in a down candle and the high. This is all thin trading in here. The bulk of the trading is done inside of the body. You use the top of the candle down to the body. This is the range that you would work within and identify. Okay, so as price would drop down at a later time into that, that's how you would use it. You do not use the bottom of the bodies of the candles and the wicks. Okay, there's a camp that teaches this idea that if you look at this, and I'll give it to you kind of like in the way it's presented in their indicator. Um, if you look at it like this, they'll say that this is dynamic support. There's nothing dynamic about that, because in reality, what you're suggesting is that in all of the wick, that's where the interest is in buying, when in fact it's not. This is inerrant price action, and many times it's raids. And a bank, when I'm in a banking level, if I want to key off a particular price level, I know that a low, okay, for instance, the body and low of this candle here, say I want to run the stops that would be obviously right below that low, they would have sell stops below this. Okay, so all I have to do is offer a buy limit to pair up with, and the market will jump down there because of my volume. It'll fill it, and it'll jump down there, fill it. But that one print in price action, making that one trade, will make all of the pending orders that reside below that level. Okay, they'll go hot, and then all of a sudden, every pending order on a limit or stop does what? Becomes market orders. To do what? What? Sell. They're going to be looking to sell it, because if they're trying to be buying down here, okay, they're going to protect their position below the low. Well, if they're going to sell their position by default, I want those positions, so I will be buying it. And that's what smart money does. They put a large pocket of uh, buy orders on limit, okay, below key lows, okay, and that's what absorbs retail and large funds that have stop orders below there. And all it takes is one order to pair up, just like that. Those orders become market orders, and once that price prints one time, it activates everyone's order, and then that's when you get these big surges. Okay, so that's how you really look at what is deemed dynamic. So the dynamic support would be, really in reality, is the high of the candle that's down prior to move up to the body of the candle. This is the dynamic support level. Okay, so you're looking inside of this range, okay, for ideas to frame a bullish scenario, not to pick the low or the bottom in this down move, but to suggest that there would be something to halt, on at least for the short term, the downward pressure. Now, could this become a low and ultimately turn around and go higher in longer term? Certainly can. But we teach, and I maintain in my own trading, trying not to pick bottoms in the marketplace. Now, did I buy this last week and get a handsome profit on it? Absolutely. Did I hold it the entire week? Absolutely not. Okay, because it goes against the higher time frame directional sell program that is clearly depicted on your chart. But because we understand that we have price moving into this area, we don't trust every time it breaks a low in here. We don't want to anticipate continuation into that, because they may just take it lower and then have the scenario like we discussed here unfold. And that's exactly what took place last week prior to the time we're releasing this video. So now let's go and look at a time frame lower than the weekly, and that would be the daily. Okay, and let's zoom in a little bit on this one. All right, so now we have this um, level that we've highlighted on the higher time frame.